Let's look at a number so big it almost loses its meaning: $27 trillion. Right now, that amount of capital is sitting completely motionless in bank accounts around the world. For decades, the global financial system treated this idle cash as an unavoidable cost of doing international business. To make sure cross-border payments eventually clear, banks are required to park massive cash reserves in various accounts across the globe. This is called prefunded liquidity. Think of them as heavy financial anchors permanently dropped at major geographic hubs. But a recent geopolitical shock in the Strait of Hormuz exposed a massive flaw in this system. Suddenly, the physical world of global trade began moving much faster than the financial world could keep up. As shipping routes tightened, the cost of moving goods spiked instantly. More risk insurance premiums for cargo vessels jumped from 0.1% to over 10% of the vessel's value in a matter of hours, demanding immediate cash outlays. This created a severe paradox for energy exporters. They had the capital on hand to pay these surging costs, but they physically could not move the money fast enough to cover them. In a crisis, those massive pre-funded cash buffers do not act as a safety net. They become a dangerous constraint, paralyzing a company's ability to respond to immediate market shocks. To understand why cross-border money moves slowly, we must look at the corresponding banking system. Because banks lack direct relationships, a single digital payment ping-pongs through multiple intermediary banks, stalling temporarily at each stop. This disjointed multi-hop process is painfully slow, taking up to 5 days to finally settle. That multi-day delay is a massive liability in modern commodity trading, where cargo prices, insurance rates, and collateral demands are constantly shifting by the hour. While the correspondent banking network was built to ensure reliable settlement during periods of stability, its built-in delays turn it into an engine of financial risk the moment a geopolitical crisis hits. Consider a commodities trading desk based in the UAE. They might hold billions of dollars in reserve in a European bank account ready to deploy. When their cargo gets abruptly rerouted away from a conflict zone, like the Strait of Hormuz, the desk is instantly hit with enormous margin calls and steep insurance spikes. Despite having plenty of capital in that European account, the legacy delays of the settlement system completely prevent the desk from accessing and deploying those funds right when they need them most. When the money gets stalled, the operational fallout hits the entire supply chain. Shipments are paused, obligations are missed, and financial pressure cascades. It reveals a crucial distinction in global trade. Having capital is not the same as being able to move it. Liquidity that cannot move at the speed of the crisis is functionally useless. Before the recent crisis, upgrading cross-border payments was treated as an efficiency measure to cut banking fees. Now, modernizing this infrastructure is treated as a vital pillar of national economic defense. The structural solution currently gaining traction is a platform called mBridge, which runs on wholesale central bank digital currencies. Instead of forcing payments through that tangled web of intermediary banks, mBridge bypasses them completely. It allows for direct central bank settlement. This single change collapses transaction times. What previously took up to 120 hours of waiting can now be finalized in just a few seconds. This direct settlement model is actively being piloted right now between regions like the UAE, China, and Hong Kong to ensure their major supply chains keep flowing under stress. The ultimate impact of this system is that it releases that trapped $27 trillion. It doesn't print new money. It simply allows existing, idle funds to be deployed on demand without the need for pre-funding. In an era defined by geopolitical volatility, stability alone is no longer enough. The sheer speed of financial settlement is now the ultimate competitive advantage for survival in global trade.